Toronto rents rose 3 months straight. They're also down 21 straight months. Same city, same report, both true. Here's why that matters. Welcome back to Smart Real Estate. I'm Adi Saeed.
And I'm Raghu Ramprasad. Adi, we've got a genuinely loaded episode this week.
We do. Rent data that looks contradictory until you understand what's actually being measured. A REIT going private, a lender taking back the keys on an office tower, and the numbers behind what actually traded in Ontario multifamily last month. Not the survey version, the registry version.
Plus, a policy story out of Brampton and a retrofit in Toronto that might change how we think about aging buildings entirely.
Let's do this. Let's start with the numbers everybody's going to see this week. National asking rent down 4.3% year over year in June to $2,033. 21st straight months of annual decline.
Which sounds like more of the same.
Except the same report also says rents were up 0.2% month over month in June, the third straight monthly increase since a 35-month low back in March.
Okay, now I know a smarty's going to hear up 3 months in a row and down 21 months in a row in the same breath and think we mixed something up.
Let's actually explain it because this trips people up constantly. Month over month compares this month to last month. Year over year compares this month to the same month last year.
So the annual number is still catching up to a much higher starting point from a year ago.
Exactly. Rents cracked hard through 2024 into 2025. Even if the market's been improving month over month since March, it takes a while for the annual comparisons to stop being negative.
What's the number that tells us how close we are?
Well, Toronto specifically, the annual decline there has narrowed to just 1.9%, the smallest gap in the 29th month losing streak. Toronto rents also rose 1.2% month over month in June, the third straight monthly gain.
If that keeps compounding,
the annual number flips positive. That's what an actual bottom looks like in the data before it's obvious anywhere else. And it's not uniform across GTA. Toronto core at $2,543 average is up 1.2% month over month. Compare that to Scarborough, down 11% annually. Markham is down 10.2%. Niagara Falls is down 12.5%.
oh, same metro, completely different story, 20 minutes apart.
There's a mechanism there too, not just noise. Toronto's core has less new supply landing right now. A lot of the suburb markets got hit with the last building wave, not too much new inventory right when demand cooled.
From a financing lens, this actually matters for how we underwrite. If someone's bringing me a deal in Scarborough versus a deal in central Toronto, I can't use the same rent growth assumption for both anymore.
And that's the real takeaway. One GTA rent number doesn't exist anymore, if it ever did.
One more thing worth flagging before we move on. 3-bedroom units in Toronto are actually up 2.5% annually to 3,588. That's already positive.
So family size purpose-built is tight enough that it turned before everything else did. If you own a 3-bedroom product in the city, you're already ahead of the trend.
Bear case though. This is 1 month of data suggesting a possible bottom. It's not confirmed. Rents are still down almost 7% over 2 years.
Right, and if you're underwriting off this, stress test it. Don't extrapolate 3 good months into a permanent recovery. So key takeaways, Toronto's annual rent decline has narrowed to 1.9%, the smallest gap in a 29-month stretch, with 3 consecutive monthly gains since March. Month over month and year over year measures different things. Both reading can be true simultaneously without contradiction. The GTA is diverging sharply by submarket. Toronto core stabilizing, while suburbs like Scarborough and Markham continue falling. 3-bedroom purpose-built rents in Toronto are already in positive territory annually. Family size inventory is turning first. Something worth noting, whether Toronto monthly gains continue through the summer leasing season or reverse, 3 months is a trend, not a confirmed button. And whether suburban markets follow Toronto's stabilization pattern with a lag or continue diverging due to oversupply from the last building cycle.
Let's talk rates, because this affects every renewal conversation I'm having right now. CIBC's Andrew Grantham flagged that the Bank of Canada's 2-year ahead inflation expectations hit 3.2%, highest reading since 2023.
That sounds like a reason for the bank to stay hawkish.
Here's the catch, and it's important. Those survey responses were collected between May 1st and 21st, when oil prices were still elevated. Grantham's own note says treat this with caution.
So what's more current?
The Business Leaders Pulse survey, a more up-to-date read, showed 1- and 2-year inflation expectations already coming back down in June. 5-year expectations stayed anchored through the whole oil price swing.
So the headline number is stale by the time you're talking about this.
Somewhat, yeah. Consumer expectations moved similarly. Canadians' survey of consumer expectations showed rising inflation expectations too, but again collected during that same elevated oil window, follow-ups into late May.
So any positives in there?
Few quiet ones. Fewer firms cited tariffs weighing on exports than before. The share, expecting higher exports over the next year, rose above its long-run average, and so did the share planning to invest more, though Grantham notes both could be inflated by a low base from a year ago.
And households?
Feeling a little less negative about the labor market, particularly in trade-sensitive sectors. There's also a detail on the Canada Groceries and Essentials benefit. About 45% of surveyed households expect the one-time top-up, and roughly half of those expect to spend more than a quarter of it. The key takeaway: two-year inflation expectations in the Business Outlook survey hit 3.2%, the highest since 2023, but the survey was fielded during a May oil price spike. The more current Business Leaders Pulse survey shows 1 and 2-year expectations already easing in June. 5-year expectations stayed anchored throughout. Few firms cited tariff drag on export, and investment intentions rose above the long-run average, though partly attributable to a low base effect. Households feel slightly less negative about the labor market, but rising inflation expectations are still pressuring spending plans. It's something worth watching. Whether the next Business Outlook survey confirms the June easing trend once oil prices are reflected in a full survey cycle, and what this means for anyone with a mortgage renewal in the next 2 to 3 quarters. Noisy data like this rarely moves the bank's hand in either direction on its own.
The next one is a distress story out of Calgary, but stay with me. There's a real Ontario thread in it.
Slate Asset Management, right? The Toronto fund?
Yep, yeah, you got it. Slate had 7 Calgary office towers up for sale to satisfy creditors. 6 sold, the 7th, Life Plaza, 66% occupied, Class B tower. Nobody wanted it.
So what happened to it?
The lender took it. Timbercreek's Financial acquired it through a credit bid. They lent Slate $41.4 million back in 2018. Slate defaulted in 2023, went through 2 forbearance agreements, and defaulted again.
Walk me through what a credit bid actually means for a smarty who's never seen one.
We talked about this before too. What it means is the lender is owed enough money and the asset is worth little enough beyond that debt that the lender just takes the title instead of running another marketing process. Instead of going to market and trying to sell and find another buyer, they basically just buy it. Per the receiver, Timbercreek was the only party with an economic interest in that building.
That's the lender protecting its own recovery, not a vote of confidence in the asset.
Exactly. And that's the risk framing it here. This isn't a comeback story. It's a lender minimizing further losses.
You said there's an Ontario threat?
Yep, same Slate fund, Slate Canadian Real Estate Opportunity Fund 1, which owns the Dixie Outlet Mall in Mississauga as well. Also in receivership earlier this year.
So the stress at the fund level doesn't stay in one city.
Nope, it follows the fund. If you're doing diligence on anything tied to this sponsor, that's a name to know. So, key takeaways. Timbercreek's Financial acquired Slate's Life Plaza office tower via credit bid after Slate defaulted on a $41.4 million loan and broke 2 forbearance agreements. A credit bid signals the lender is protecting recovery on a distressed asset, not a confidence in its value. Life Plaza was the only one out of the 7 Calgary towers that found no buyer. And the same Slate fund, Slate Canadian Real Estate Opportunity Fund 1, owns Mississauga Dixie Outlet Mall, also currently in receivership. Fund level distress crosses city and asset type lines. Something worth watching, whether other Slate-affiliated Ontario assets face similar creditor action as this fund's distress unwinds further. So Smarties, quick reminder before we keep going. Everything we cover in this episode is free. Head to learninvestmanage.com, sign up, and you'll get access to every LIM tool, plus an invite to our school community. No cost, no catch.
All right, back to it.
2 deal flow stories this week, and they couldn't be more different in scale. Let's start with InterRent.
One of the bigger public apartment REITs in the country.
InterRent announced on July 2nd that all closing conditions on its take-private arrangement with Carriage Hill Properties Acquisition Corporation are satisfied. $13.55 per unit, cash, closing around July 9th. After that, a delist from the TSX.
What's the actual signal there for us?
Interesting one. When public markets are pricing REITs below what private capital thinks the real estate is worth, eventually someone takes the whole thing private to capture the gap. We lose something though. InterRent's quarterly disclosures were one of the better public data points for on rent and vacancy in that sector. That transparency goes away once it's private.
Notice something in that release worth flagging from my seat. The interim CEO specifically thanked CMHC for its collaboration throughout the process.
What does that tell you?
That insured-debt was almost certainly a gating item in this transaction. When a portfolio carries CMHC insured mortgages, the lender's consent to any change of control isn't a formality, it's a real negotiation. Worth remembering anytime you're structuring a deal on insured debt, your capital structure isn't fully yours to change unilaterally.
Great segue, actually, into the second piece, my own numbers from the Ontario Registry for June. So, 64 registered multifamily deals in Ontario in June, $322.4 million in considerations. Looks like a strong month on the surface.
But
The two biggest trades, roughly 43 million and 41 million, were seniors and retirement housing acquisition by a major operator, priced on care revenue, not apartment rents. A large deal, about 42 million, was 50% interest joint venture recapitalization on a downtown Toronto rental. One partner buying into a stake in something they already jointly own, not an open market sale.
So none of the three biggest numbers actually tell you what conventional apartment buildings are trading for.
Right. Strip those out, and the real signal is the middle. 45 deals in the $500K to $6 million range. Typical price around $1.9 million. And it's not just GTA and Ottawa. Thunder Bay, Sudbury, North Bay, Sault Ste. Marie, and Bancroft all saw registered trades.
Let's talk financing, because that's where I live in this data. What did you see?
A clean split. Stabilized buildings that qualify are getting 5-year insured-style financing in the mid to high 3%.
That's a genuinely attractive cost of capital right now. The building and the financial support it.
At the margins, deals leaned on bridge financing and private or mid-capital priced meaningfully higher.
One thing worth saying clearly for anyone who goes digging down through land registry data themselves, face rate on a registered charge can be misleading. Something registered at prime plus 10% or 24% is very often a collateral of security registration and not the borrower's actual cost of funds.
That's a very valid point. Underwrite the real money, not the scariest number on the page.
Exactly. And one more data point worth naming. May had a real distress story. Cluster court-ordered receivership sales at the top of the market. June had none. No vesting orders, no portfolio liquidations repeated.
That's worth watching rather than assuming it's a trend either way. And separately, third-party research is flagging softening rents across Ontario broadly, which puts real pressure on how deals get underwritten through the rest of the year. If you're buying, stress test your rent growth assumptions rather than extrapolating the last few years forward. So key takeaways. InterRent REIT's take-private arrangement closes on or about July 9th, removing one of the sector's best public data points on rents and vacancy. CMHC's involvement, thanked explicitly in InterRent's release, signaling insured-debt was a gating item. A reminder that CMHC insured capital structures require lender consent on ownership changes. Ontario's June registry showed $322.4 million in deals across 64 transactions. But the two largest trades were senior housing, priced on care revenue, and a JV recapitalization, not an open market sale. The headline number overstates conventional apartment pricing strength. The real signal is 45 deals in the $500 to $6 million range, typical price at around $1.9 million, with activity reaching well beyond the GTA into secondary and tertiary markets. The financing split cleanly, mid 3% insured style money for qualifying, stabilized buildings, meaningfully higher bridge or MIC pricing at the margins. Something worth watching, whether third-party research showing softening Ontario rent shows up as a rent growth assumption correction in Q3 and Q4 underwriting. Also, whether June's absence of forced sales activity holds or May's receivership cluster was the start of a longer trend rather than a one-off. So, shifting to new supply, Brampton just broke ground on Rose Towers, 4 towers up to 30 stories, all-purpose built rental along the Queen Street corridor.
What made it pencil? Because purpose-built rental economics have been brutal for years.
According to the developer, it was policy, specifically removal of the HST on new purpose-built rental construction, combined with the limited time development charges waivers from the Region of Peel and the City of Brampton. Their quote, without those changes, required rents would have been significantly higher.
Worth flagging. That's the developer's characterization of their own project economics and not an independently verified figure.
Correct. No dollar figures on the actual gap these policies closed, but directionally, it lines up with what we already know. HST removal and development charge relief are real, verifiable provincial and municipal policy changes, not just talking points.
From where I sit, this is also a signal about future supply side risk for anyone lending against or holding existing property in that specific corridor.
Right. New purpose-built supply landing at scale doesn't just help future tenants find housing. It changes the rent growth math for buildings already standing nearby.
So if you own in Brampton's core, this is worth watching closely over the next 18 to 24 months as these units come online. Key takeaway. Rose Towers, 4 purpose-built rental towers, 26 to 30 storage, breaking ground in Brampton's Queen Street corridor developed by Skyline and Solmar. The developer attributes project feasibility to HST removal on new purpose-built rentals, plus Peel Region and Brampton development charge waivers, verifiable policy changes. Sure, the developer's specific cost gap figures are not independently confirmed. New concentrated supply in one corridor is a two-sided story, positive for future tenants and the city's housing goals, but a rent growth headwind for existing nearby landlords. And something worth watching. how absorption plays out as these units and similar policy-enabled projects elsewhere in Ontario come online over the next 2 years.
Last one, and I think this is genuinely important for anyone holding older Ontario apartment stock. CBC covered a retrofit underway at McCleary Towers in Toronto's East End, a 1967 building, 160 seniors unit owned by Wood Green Community Housing.
What's actually being done to it?
A lot. Full building air conditioning, direct ventilation to every suite, rooftop solar, and they're targeting net zero carbon. The method is prefabricated panels installed from the outside, essentially wrapping the tower rather than gutting it from the inside.
Tenants don't have to leave.
That's the headline detail. 160 seniors stay in their homes through the whole retrofit. The project's funded through CMHC and Natural Resources Canada.
What funding details matters to me specifically? CMHC and NRCan backing signals there's a federal capital stack designed around exactly this kind of retrofit, relevant for any owner of aging purpose-built stock trying to figure out whether retrofit in place financing exists as an alternative to a full redevelopment play.
The architect on this called it a potential blueprint for the wave of aging apartment buildings across this country. The idea being you can extend the building's life another 50 to 100 years instead of defaulting to tear down and rebuild economics.
Worth being clear, this is a nonprofit owned building, so we don't have private investor financing specifics from this article. But the model itself and the fact that federal capital exists to support it, that's a transferable part.
And completion is expected in spring 2027, worth watching as a genuine test case. So a couple of key takeaways. McCleary Towers, 444 Logan Avenue, Toronto, 1967 built, 160 seniors housing, being retrofitted to net zero standards using exterior prefabricated panels without displacing the tenants. Project is funded through CMHC and Natural Resources Canada, signaling a federal capital stack aimed specifically at extending the life of aging affordable housing stock. An architect positioned this as a replicable blueprint for Ontario's aging apartment inventory, an alternative to tear down and rebuild economics. Though financing specifics here are non-profit specific, not directly transferable to private ownership without further details. Something worth watching, whether similar CMHC and NRCan backed retrofit financing becomes accessible to privately owned aging apartment stock, not just non-profit portfolios. So there were three themes from this episode. Number one, the market is stabilizing unevenly. Toronto core stabilizing while suburbs and secondary regions are still correcting. And the same divergence shows up in deal flow where headline numbers hide much steadier mid-market underneath. Number two, distress and disruptions are following capital, not geography. A Calgary credit bid connects straight back to a Mississauga receivership through one fund. A REIT going private removes a public data point Ontario investors relied on. And number three, policy is doing real measurable work on both ends of the building lifecycle, enabling new purpose-built supply in Brampton and extending the life of 1967 era stock in Toronto through federally backed retrofits. Key takeaways. Toronto's annual rent decline has narrowed to 1.9%. Watch for the flip to positive territory if monthly gains continue. Number two, the GTA is not one rental market. Core and suburbs are moving in opposite directions. Number three, fund lever distress travels. The same Slate fund connects a Calgary office tower to a Mississauga Mall receivership. Number four, InterRent take private removes a key public data source. CMHC consent was clearly a gating item in the deal. Number six, Ontario real June deal flow is the $1.9 million mid-market, not the misleading $322 million headline. Know your financing lane before you underwrite. And number seven, policy is reshaping both new supply in Brampton and older building retrofits in Toronto. Watch both play out over the next 12 to 24 months. Smarties, that's the show. If there's one thing to take away from today, it's this. Read every headline number twice. The averages hide more than they reveal right now.
And if any of this touches something you're financing, underwriting, or renewing, come find us.
Everything we do is free. LearnInvestManage.com. Sign up and you'll get access to every LIM tool, plus an invite to our school community to connect with other investors.
We'll see you next week, Smarties.
Take care. Adi Saeed is a licensed real estate broker with Remax Gold Realty Inc., RICO license 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. Vibhu Ramprasad is a licensed mortgage agent, level 2, with BLD Financial, DLC license 12360. The host may reference companies or entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group, Listeners should be aware of these relationships when evaluating any commentary in this episode.
This podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decision. Past performance is not indicative of future results.